In addition to our trend lines, what might also help us is moving averages. And so we can kind of feel for where the average pricing over a period of time is moving, or what direction is it moving, and how does it relate to maybe our trends and our trend lines. So let's look at moving averages here real quick. So here is our chart of that we were looking at before to keep consistent with the price and time. And this is a simple moving average that we're looking at here. You can see the line that's being drawn through here. We've got our candlesticks. You can see there's this line that goes through. That is a SMA, or simple moving average. And really how that's figured out is you add the closing price for a number of time periods, and then dividing that total by the number of time periods. You're looking at price times time periods divided by the time periods to get you an average, right? That's what would be your average. And this is a simple moving average where it's looking back over, in this case, the 30 time periods in a simple type of calculation. There's also what are called weighted moving averages, and that's where you're assigning more weight, and really you're assigning more weight to the more recent data. So let's say maybe I assign more weight in my calculation to the last, in this 30-day example, maybe the last 15 days carry more weight than the first 15 days because it's more recent, and thus I might say, that's more important than maybe a simple moving average where it's looking over the entire period. So they both work, and sometimes it's good to use both in conjunction. The exchanges and charts and things, systems that are out there will do this automatically for you. You don't have to do the calculations, but if you want, it's a simple formula to do the calculation. And you can see how the moving average is kind of making its way through our chart here. And let's look at this a little closer here on how to interpret this and how we might make decisions on, let's say, a simple moving average. So when we look at the line, prices that are above the line are showing strength, right? Rising prices. Prices that are below the line are weakness. Prices are falling. So our investment is either rising or falling. So above the line is strength, below the line is weakness. Where it's crossing over the line is what's called crossover points, right? Imagine that. What a great term. Crossover point, because it crosses the line. Well, because that's what's happening. Something is happening. Change is in the air. Change is happening. Potentially changes in the air. When it gets to the crossover points. So if we look at this, let's start with the left and work our way through and see if we can describe what is happening in this 30-day market cycle here that we're looking at. If we look at our trending line up, right, we're looking where it was trending up, and then we have all those green candlesticks and everything's trending up. The moving average is going up too, because remember that period is looking backward at prices. They're going up, so the moving average is going up. We then hit this patch where prices are starting to come down, so our moving average is going to start to flatten out, and eventually it's going to go downward. As you can see, it goes downward, and then it's going to kind of continue that downward type of trend with little peaks and valleys there, but it's smoothing everything out. And that's one of the benefits of a moving average. It smooths everything out so you can kind of see a little bit better versus than all this scattered type of information. Now, if we look at the first blue box there here on the left, right at the top of where the green is, you can see this is the first point where you're now starting to see prices, the candlestick, opening and closing, starting to cross the line. And it's going between the line, up and down, all between the line. It's really kind of steady there for that, that 7-day period we were looking at. Why? Because the market is in flux. The market is trying to decide, are we going to go to higher prices, or are we too high and we need to pull back and go to lower prices? You might have heard the term bulls and bears. The bulls would think the prices go higher, the bears would think the prices go lower. We're in a trading range here where people are, these individuals are deciding, and you have enough bulls and bears, enough people trading, selling and buying, that you have people who are now looking at this moving average, and we're now crossing the moving average line. At the end of the blue box, what happens? Well, it looks like the bears won out. Prices go down. You can see they've gone down below the moving average line, and they stay below the moving average line and stay significantly along the moving average line, below the moving average line. And because it's a moving average, the line now starts bending and moving to the bottom too. It's not a straight line, it's a moving line. And thus that's moving with it as prices go down. And you think about it, as they go far enough down, people say, yeah, I should buy the market, it's pretty low, and it'll start to go back up. And we might start seeing that at the bottom where it hits the big volume areas and really hits rock bottom and now starts coming back up. And we've now entered into the second blue box there, where we see prices going above and below the line. And now this is a period where we'd want to watch again and start seeing where the trend might emerge. And as it emerges, is the trend going to go down like it did previously, or is it going to go up? And that's where the moving average can help you as far as what might be going on, because we're looking at now pricing averages over a period of time in active markets. Once again, a weighted moving average would assign more weight to this recent downtrend than, let's say, a simple moving average with just putting more weight towards the overall, or doesn't put weight anywhere, it has it over the overall trend. So it's taking advantage of that first 30 days ago, that first big green rise. Let's look at this here. If you see, I draw just some simple trend lines here. Remember that point where we're wondering what might be happening with the market after we hit that peak? Well, if we overload those trend lines in the trend channel, you can kind of see now that we've got more information. This might tell me that we've got a simple moving average. We've crossed below the average. We've peaked up a bit above it, but now we're crossed below it again with our very last data point there. And our trend lines tend to be trending down. If I was a technical analysis trader at this point, I might say to myself, I might need to see a couple more data points to see if this trend is going to continue this downward trend and then act accordingly or not act at all. Or do I think we're about to go above the moving average line and our trend might be reversing, waiting for that trend to happen and then getting in that trend and riding that trend out. So we're really at, if I'm looking at this chart at the far right, I think we're at a real decision-making point of what might be happening next. And that's where moving averages and trend lines can really help you out. Now we're going to look at, the next lessons, we're going to look at some shapes and geometric shapes to help explain this maybe a little bit more and looking for opportunities.